Hi everyone, good evening. It's been a minute after the first class, and I hope you've been well. I hope you studied the first class and you learned you were able to pen down some things. We spoke about budgeting, savings, and investment. And I hope you've been actually applying the principles. You're budgeting, you're conscious of your monies now, and no matter how little you get, you're conscious about how much you want to set aside, all right, for certain things. All right. So in our first class, we talked about a bit of budgeting and also the importance of savings, and what we said was, in the totality of basic financial management, financial literacy, our goal is actually to delve towards how to multiply our monies, all right, how to invest our monies, how to understand how money works. Just a few recap of the things I said in our first class. I said money is not meant to be kept, okay? Well, for every time you keep money, you lose money, all right? Because inflation keeps going up, the prices of things keep going up, all right? So the money you think you have saved in terms of value is actually reducing, because as prices go up, as inflation increases, the value of your money keeps reducing. So money is not meant to be kept, all right? I remember I gave you a scenario about a story in the Bible of a king who, when he was traveling, gave his servants different talents, 5, 3, and 1, and when he came back, you could see that he reprimanded that one servant who did nothing with the talent he was given, but commended the other two who, regardless of the situation, the situation that made that one person not to do anything with his money, regardless of that same situation, did something and got some returns. What does that say to you? That is the attitude of money. Money is meant to reproduce more money. And in today's class, we will go into basic investment practices that we can actually have. When I mean basic, that is any one of us. Any one of us can access these. Investment options. Okay, first is fixed deposits. Alright, many of us are not aware that there is something called fixed deposit. Okay, sometimes you have money in your bank and you've saved a certain amount of money in your bank balance, in your savings account as well, or your current account. Now your current accounts attract what bankers call COT, or account maintenance charge. So for every time you use that account, you pay the bank for every transaction you do on your current accounts. But alternatively, the savings account is not like that. Okay, in the savings account, the bank pays you interest at the end of the period for how much you saved, which is it's good. But not many people know about fixed deposit account, and it's very important. That is because the interest rate you get from the bank on your fixed deposit account is way higher than that which you get on your savings account. And let me tell you why. The money you have on your regular savings account, okay, it's like a call deposit. It means you can come to the bank any day and you request for the money. All right, so the bank is going to pay you little interest, okay, on that money. And besides, the practice here in Nigeria, if you withdraw more than 3 times in a month, you don't up to 4 times in a month, you don't get an interest at all. Okay, but with a fixed deposit account, what you're saying is, I want to keep my money with the bank for a specific period of time. Okay, 1 month, 3 months, 2 months, 6 months, 1 year. It's a short-term investment. Okay, so the bank pays you a higher interest because of the assurance that you've given to them that yes, you would leave this money with us for this period of time. Now, why is this important? Why is the bank paying you a higher interest for that? That is because the bank is in the business of taking money from you who wants to save and giving it to the guy who wants to lend. All right, so you have no need for your money, you want to save it in the bank. Now the bank in turn takes that money and gives it to that person who has a need for the money at that particular time. Now that person might not be paying back the money almost immediately. All right, so the bank needs to stay solvent. That is why they give you a high interest when they know that you have this money kept with us for a longer period of time. Okay, that's the higher interest you get on fixed deposit. It's important. All right, so that is one option. I mean, that is the basic option. It's a risk-free option, a very risk-free option. The bank is not going to vanish tomorrow with your money. Even if they do, we have NDIC to go to. Okay, it's a risk-free option. It's a risk-free investment. You create higher than what you have on your returns for us. Then another option, practical option investment that we can take advantage of is treasury bills. Now, treasury bills are short-term investments. It's a way of the government, either either carrying out open market operations. It's to say the government wants to raise money, okay, for short-term activities, maybe anything within 1 year. That the government, I mean, if the government has any project, okay, and they need money for within that short-term period, okay, the government sells treasury bills. Or alternatively, if there is too much money in circulation, okay, and the government wants to contract the money supply, the government wants to reduce the total money in circulation, the government will sell treasury bills at an increased rate to attract you to save your money, to attract you to purchase those treasury bills. And in purchasing treasury bills, right, the government is mopping out excess liquidity from the market, excess money in circulation. So that way the government is able to achieve the objective of reducing the total money supply, and at the same time you are actually earning a higher interest from that treasury bills. Now, treasury bills, the rate of treasury bills are as high as 17%, sometimes 20%, depending on the period. Because prior to 2017, treasury bills was practically available every time. But for the past 7 years, the government buys treasury bills intermittently. It's only about for a year now. It's been a bit regular. But before now, there's a time, especially after COVID, it was a very prolonged period of time the government wasn't buying treasury bills and the rate was practically 0%. All right. Now, treasury bills and fixed deposits, all right, are short-term investment that gives you double-digit returns. What I mean double-digit returns is returns above 10% and above. Now, see where it gets really interesting. Now, say you need money for a project, all right, or say you have a family member who has a lot of money, all right. Now you can share this idea with them. Say I have my mom right now, she has so much amount of money saved in her savings account. You can talk to her about fixed deposit and about treasury bills. Say you have a project you want to run for a short period of time, say 1 year, all right, and you have the money to execute this project. This is where we become smart with money. You necessarily do not have to spend all your money every time. Robert Kiyosaki actually said debt is good. Debt is a good thing, that if you're using it the right way. You don't borrow money to spend on liabilities, you borrow money to spend on assets. What I mean is, you borrow money to spend on assets that generate more money, that is enough for you to pay back the finance cost of the money you borrowed. Now, it shouldn't for some of us it might sound new to us, but you should actually know that there are some government agencies that give single digit loans to certain businesses. Those organizations tend to encourage businesses that are into agriculture and some other business. There are some government agencies that give you loans, short-term loans, for 1 year, for 18 months at 9%, single digit. Some could even be lesser. All right. So if I'm to execute a project and I need, say, 10 million to execute this project, all right, I can put my money in treasury bills investments at the rate of 17%. Okay, and go to these government agencies, all right, and get a loan at 9%. What that means is the returns from my treasury bills investment pays for my loan repayments, okay, and I still have an extra. We're talking about financial literacy, so you need to be smart with money. It is not wrong to borrow, but you don't borrow money you don't borrow money on things that do not generate revenue. That's where many people get it wrong. You borrow money to get married, you borrow money to buy a car, you borrow money on things that that have diminishing returns, things that you're using, and for every time you use it they reduce in value. No, you borrow money to spend on things that accumulate wealth for you, that accumulate values for you. For every time you borrow money, I mean, borrowing money to pay rent is your it's financial suicide. All right, because your rent does not generate more money for you, it's purely a liability. So you should be paying your rent from the returns, okay, of the money of the investment, that your borrowed funds are producing. That's how that's the thing about being smart with money. You don't borrow money for liabilities, you borrow money for assets, so that the assets will generate more revenue, all right, that pays off your loan and gives you a little extra. It's, I mean, a very practical example. I just told you about treasury bills. I could purchase treasury bills today at 16%, at 17%. And so my money is kept with me. I have a higher interest rate, and I could go borrow from, government agencies that would give me a single digit loan. All right, and I have extra 7%, I have extra 8% to myself at the end of the period, because why? I'm smart with money. I do not, you don't borrow money. Don't forget, if there's anything you want to remember, I said today, do not borrow money to spend on things that do not generate future cash flows. You borrow money to spend on things that will generate for you future cash flows, because those cash flows would pay for your loan repayment, okay, or your interest payments, right, while you have extras. All right, so you need to know how to spend money. It is not wrong to borrow money for your business. It is not wrong, but you see, like I said, you must you borrow money into a venture that generates more money, not into something that takes money from you. You borrow money to get a car, except you want to use the car, for a taxi hailing business. If you want to use the car for your personal consumption, you're setting yourself up, because your car is a liability. And there's cost of maintenance. You have to service your car every month. Okay, I mean, something could go wrong, you have to fix. You probably have to upgrade. Your cooling system could go bad, and you have to fix it. So all these are several things that would be demanding, that will be demanding of your finances, because of the car that you've bought. And don't forget that you have a repayment to make. Okay, so getting smart with money, understanding how money works. Okay, like I said, money is a game. Okay, it's a game, it's a smart game, and you need to play it smartly. All right, a lot of individuals you see doing so many things, building infrastructures. A lot of those monies are borrowed monies from the bank, which is why it's also important to have a very good financial character. Your bank should have the confidence enough, to be able to loan to you. So you see, that's something you also need to build. What is my financial character? Like I said, not our banks in Nigeria right now might not be so targeted at small and medium, let me say small enterprises. But you see, some actually do have certain products, that as a small business you can actually have access to. But the thing is, what is your credit character? That is also very, very important. Okay, as I also spoke about government agencies. These are agencies that are willing to give you, loans at single digits. So if I have the money to spend on a particular project, I can take the project proposal to these agencies, submit it to them. Okay, you get the facility, then you put your money into you make your money an asset. All right, by buying treasury bills, by buying fixed deposits, by making those investments, you've made your money an asset that will generate returns for you, right, while you're settling your while you're setting your obligations. Okay, so this is how to think about money, this is how to be smart with money. All right, today I had spoken about a very basic investment practices that we can learn to do as individuals. The minimum amount of money you can invest in the bank in fixed deposits or treasury bills, I think, is about 100,000. That is how minimum it can be. All right, but keeping your money in a savings account, you're tempted to do a lot with it. You want to buy credit, or someone reach out to you, okay, I need this money for this and all that, and next thing, you touched it, and that's it. It just keeps going down until it's nothing. You must learn basic practices. All right. Like I said, it's unwise, very unwise to keep your money in a savings account. Your money has to be put into productive use. You must learn the concept of investment. Explore treasury bills, explore fixed deposits. These are short-term, risk-free investments you can actually do at the moment. But most importantly, you must understand the money game. That is, if I have money to spend on this particular thing, then ask yourself, where can I get the money to do the thing at a lower rate? And which investment can I put this money in that can give me a higher rate? You see, you're playing the money game. I have 10 million. I have a project. Okay, if I can get a loan from maybe a government agency or from another source at single digits, maybe at 8% or at 9%, then at the moment treasury bill is at 15%, 16%. All right, so secure the loan. All right, secure the loan, then do your investment in treasury bills. You would have played the money game and you have an extra of 6 or 7% to yourself. That's what being smart with money is. Okay, so you necessarily do not have to always take all your resource and put in a project. No, explore debt, explore equity financing. It's important. There's nothing wrong so long as that money is invested into that facility is converted into an asset that will generate future returns. All right, so today I have spoken to you about risk-free investments. Next class we will talk about some risky investments that are also worth exploring. Let me leave this with you so you could have this in mind before our next class. That is, if you want to grow wealth, okay, you have to explore both options, both the risk-free investment and also the risky investment. Yes, okay, but being smart is you allocate a larger percentage of your finances in a risk-free investment, then a smaller percentage in a risky investment, because though it's risky, but you see, the more risk, the more the returns, and sometimes it pays out. It pays out even more than your risk-free investment. Okay, so we'll talk about this in our next class. Okay, so I'd like you to brood over the things I've shared with you today. Then in our next class we'll take it one step higher. All right, thank you so much for listening to me today. Do have a lovely day and I look forward to seeing you in our next class. Thank you so much.